Today we're going to talk about the difference between closing costs and down payment. We'll go over which each one is, how much to expect for each one of them, and then at the end we'll go over some tips to hopefully save you some money in closing costs. So think of your down payment as your initial investment into the home. If you're purchasing a home for $100,000 and you put 10% down, that would be $10,000. A 20% down payment, and that would be $20,000. Now, as far as what you need to do, that depends on a few things. So typically down payments today are going to be anywhere from 3.5% to 20% down. Now, this is going to depend on how much you qualify in terms of a home loan and whether or not you want to pay mortgage insurance. Mortgage insurance isn't anywhere near as expensive as it used to be, so I wouldn't look at 20% down as a necessity. If it's going to stretch you financially, or if you want to save some of your extra money for repairs, closing costs, things like that, I wouldn't rule mortgage insurance out, and I would definitely discuss your different options with your broker. Now, another thing to consider for down payment is how competitive is the market. If you have 20% down and you're in a competitive seller's market, sellers could look at a higher down payment more favorably. If you're in a buyer's market and you want to put less down because there's not as much competition for the property, and again, you want to save that extra money for closing costs or maybe some repairs, you can go ahead and do that too. Now, closing costs are going to be all of your third-party fees that are associated with the transaction. This could be title insurance, escrow fees, an appraisal, home inspection, homeowner's insurance, property taxes. All of these things are included in your closing costs. Now, in California, that's going to range anywhere from 2 to 5%. So if we use that same $100,000 example, it could be anywhere from $2,000 to $5,000 depending on how much certain things are. So there's a few different strategies that you can use in order to save closing costs. The first one is when you're making your offer a price that includes the seller covering all of your costs. So if you offer $100,000, but you let the seller know, hey, I'm offering you $100,000 for your property, but this does include you paying for my closing costs. As long as they accept both the offer price and the terms, you're in business and you don't have to come out of pocket for your closing costs. The second strategy you can use is taking a slightly higher interest rate, and the lender will give you a lender credit towards closing costs. So let's say that initially you were going to get a 7% interest rate. However, if you take a 7.25% interest rate, this is going to give you a $5,000 credit towards closing costs, and essentially is going to cover all of your closing costs. Now, the argument against this is, why would you take a higher rate in order to cover those costs? Well, again, it comes down to a few things. How much money do you have set aside for these closing costs? And how much is that increase in payment really going to affect you? If it's only a small amount and you're going to stay in the house for a long period of time, this could make sense. And the third tip that we'll discuss is homeowner's insurance. You as the buyer have control over who you're going to use for homeowner's insurance and what your coverage is going to be. So as long as the lender is okay with the coverage that you're getting and you can save a few hundred to maybe $1,000, you can go ahead and do that, and that's going to save you money on your closing costs. Now, as far as where the money can come from both of these, that's going to depend. So now that we've discussed the difference between closing costs and down payment, and then giving you a few tips in order to save some money, let's talk about one more vital part of this process, and that's where can this money come from? The money needs to come from your accounts, whether it's a savings account, a checking account, maybe a 401k, stocks. Any of these is fine as long as it's your account and you have 2-month statements showing that the money is yours. You also have the ability to take gift funds from a family member as long as they're willing to send you a gift letter stating that this money does not need to be repaid.